while many are focused on the debt crisis in Europe, China's banking regulators, they are seeking to ease concerns about its country's banks and the financial health of their system. China's inflation, for example, easing last month, and my next guest finds the data encouraging. Jing Ulrich is the Hong Kong-based chairman of global markets for China at JPMorgan Chase. She has also been voted one of the top 50 businesswomen in the world by Fortune magazine. Jing, always a pleasure. Thanks for coming in. Explain a little bit about what's going on in the Chinese economy right now. The report today is that inflation has eased. Is that still the big concern of the government?
Inflation has indeed eased for the past 2 months. So CPI numbers are 6.1%. That's down from 6.5. So this is quite encouraging because the central government now has more room to maneuver if growth slows too drastically, because they've changed their monetary policy from a tightening stance to more a neutral stance. So inflation has finally come under control.
Do you believe that the government will have to somehow ease credit in order to spur growth in the economy? I think the numbers were about, what, growth of 9.1% recently?
Well, growth is still very robust by any measure. You know, in the third quarter of this year, GDP growth was indeed 9.1%. The central government at this point doesn't need to ease monetary policy on a large scale. What they are doing, however, is they're doing so-called targeted easing, especially lending to the small and medium-sized enterprises, which have had difficulty accessing bank financing.
Tell me a little bit about debt in China right now. We've all learned the purgatory achievements of debt in the United States and also in Europe. What's the situation when it comes to debt in China?
Well, the situation in China is very different from that of Europe and the U.S. Number one, the central government in China has a very small amount of debt relative to GDP, around 16% only. Local governments have slightly higher debts, around 30% of GDP. And then if you add everything else, total debt outstanding by local central governments add up to about 55% of GDP. Clearly, this is much lower compared to some of the European countries, also low compared to the U.S. So what this means is that the central government in China has a lot of fiscal resources to deploy if the economy slows down more drastically.
Tell us about property development in China. We know that the government has initiated large-scale infrastructure spending, whether it be cities, whether it be housing or commercial property. Is there a property bubble?
Well, the property bubble actually was a bit of a concern earlier in the year. So since January, the central government put on a lot of measures to contain the rapid increase in property prices. So what we've seen so far is basically those measures are beginning to have an effect. Transaction volumes in residential housing are down by 30 to 40% in the key cities. Prices now in Beijing, Shanghai, Guangzhou, the large cities, have basically stopped appreciating. If you think about it, right, demand is still very strong, but the central government is trying to suppress speculation and investment demand. But importantly, they're building a huge numbers of low-cost housing subsidized by the central government. They're building 10 million units this year, 10 million next year, and 16 million units for the remaining 3 years of the 5-year plan. So 36 million units of low-cost housing in the next 5 years.
Now, one of the government reports states that there are 64 million empty apartment units in China. Is that going to take a long time to work off?
But that number is erroneous. The 64 million number has been cited over and over again, but there's no official source that we can trace back to. So apparently that number came from some blog. No one can really verify the accuracy of that number. However, having said that, there are indeed quite a lot of empty apartments. That is because a lot of middle-class investors in China are using property as a store of value, because interest rates in the Chinese banking sector are very negative. Real interest rates are negative 5.7%. So they prefer to invest in properties. That's why we do have a lot of empty apartments. But the difference between the U.S. housing bubble before the crisis and China is that leverage ratios in China are very low. By and large, people pay cash.
I want to thank you very much. Jing Ulrich joining us, the head of China Equities, JPMorgan Chase. Appreciate your participation as always.
Thank you
very much.
Me.